Hello, I am Tamari Chatterjee. Welcome from SMIFS Limited. Today we are here to discuss some aspects on operational compliances and day-to-day challenges in operations. For this discussion, today we have with us Mr. Sudipto Datta, Compliance Officer of SMIFS Limited, Mr. Bajrang Agarwal, Head of Operations, who is a Chartered Accountant, and Mr. Amit Roy, CMA, he is the Head Risks and Compliances of SMIFS Limited. We are all aware that a client transferred the funds to the trading member upstreaming client bank account, but nowadays we are facing some challenges where we cannot find the identify the source of bank accounts. So on this particular matter, I shall request Mr. Agarwal if he can share some practical experiences on this particular matter.
Thank you, Tamari, for the introduction and having me in the show. Today, I will share with you the practical challenges we face on a day-to-day basis while recording the entries of the fund transferred by the client in our upstreaming client bank account. We accept fund from the clients through various modes. The client may provide fund to the trading members through check or through payment gateways or through other ECMS facility which we are providing to the clients with our bankers like HDFC and ICICI Bank. Now, we have certain facilities in our back office where the fund transferred by the clients are automatically recorded in the financial ledger of the client in back office. A few days back, we came across a situation where a client has transferred fund to us and provided the screenshot to the RMS department for asking them to provide the exposure. The RMS department, after getting the screenshot, verified with the payment gateway panel that whether the fund was actually received by us or not, and provided the allocation to the exchange and then granted exposure to the client. Now you all are aware that margin reporting compliance has to be done by the trading member within T+5 days. While till this time everything was fine, but while reporting to the exchange on the T+5 day, we found that there was no credit balance in the financial ledger of the client. As we could not find the funds in the ledger of the client, the operation department contacted with the RMS department and asked on what basis the exposure was granted to the client. The RMS department shared with the evidences with the back office department on which basis they have provided the exposure to the client. The RMS department provided details to the operation team to substantiate the basis on which they have provided exposure to the client. Now, while on the basis of the evidences, we tried to find out where was the entry, where was the fund lying. So we found that the client earlier had a trading account with us, and which was later on closed, and he reopened one new client account with us. But the bank account in the old account and the new account was same. And for some technical glitch in the system, the entries got posted in the old account which the client had with us. As the client had no fund in the account in which the trade has taken place, and we need to report to exchange the margin compliance, I would request Sudipto sir to enlighten us or to guide us how we can tackle this type of situations so that it can be mitigated in a proper way.
Thank you, Tamari. Thank you, Bajrang ji, and thank you, Amit, for being here. Bajrang ji, the challenges which has been faced by you is extremely unique. As you have detailed that maintenance of client upstreaming bank account has to be ensured that by the end of the day, all entries are to be assigned to any and every client. Upon hearing the challenges faced by you, which you have just now expressed, it comes to my mind that the challenges which are being faced by you are directly linked to the attributes which I keep on harping every day. What I understand, that a client had transferred funds through a payment gateway and informed through some WhatsApp messages to the RMS department. The RMS department verified the dashboard, understood that the funds have been credited. They immediately sent a request to the exchange for the allocation process of allocating margin. Once they received the confirmation file, they had given exposure on the front-end trading terminal. Till this, everything went off well. The client executed certain purchase and sale transactions, and he was absolutely correct to think that everything is in order. Somehow, when the margin compliance activity came, the back office and the RMS department woke up that the compliance is not being met because the ledger balance is nil. So what went wrong? First, there was no communication between the RMS department and the banking department. The RMS department, whenever takes a decision to allocate and provide exposure, should also verify the financial ledger of that client immediately. It clearly appears that the RMS department only saw the dashboard and not verified the financial ledger of the client. Had the RMS billing officer verified the ledger, the problem would have been plugged then and there. They would have immediately understood that there is some problem of updation of the back office which happens seamlessly in a transfer which is done through a payment gateway. They would have immediately contacted the banking department that why this credit has not come to the financial ledger of the client. The banking department, who is taking care of the BRS, also did not find this entry to be in an unallocated client ledger and reconciled the books without any iota of doubt. The problem would have been clubbed or fixed by the margin compliance department had it brought to the notice of the RMS department on the T+1 day that how the margin compliance has not been made and exposure has been given to the client. Now, how can one plug such issues? Plugging of issues is simply to be due diligent in the duty. The RMS department is the actual key department who should be very sure while verifying the financial ledger balance on online account transfers. Only looking at dashboards or the bank account does not make the department relinquish its duties or absolve them from their duties that they have done the allocation process and provided exposure. Whenever such manual entries on the front end are made, it is the duty of the dealing officer to note down each and every entry and at the end of the day personally look into the matter that the banking department is assigning each and every entry to the correct client code. You may be aware or may not be aware that any fund which is transferred to the upstreaming client bank account has to be assigned to the correct client because SEBI circular categorically mandates that you cannot give exposure without upfront margin, be it in the nature of cash collateral or security collateral. The issue could have been plugged if there was proper communication between the RMS department and the banking department. You have to be diligent, and the client cannot be under any type of financial pain to bear any losses in the name of margin penalty. The third aspect is related to the KYC department. The bank account number which was there in the account which was closed by the client had to be rearranged or reorganized in a manner so that when the new account was opened, the bank account number of the old closed bank account and the new active account ought to be separated in some manner or the other, either by putting a hash or dot or any character in the bank account, so that there should not be any mismatch while fund transfers are attributed to the client upstreaming bank account. The fourth aspect is what we have to work with the back office vendor so that whenever a bank entry is to be caused through a UPI automatically, it should first check the active account and not the closed account. This is a very important aspect, and necessary changes in the back office software has to be made. So, at the end, what needs to be stressed is the coordination between all the departments are extremely necessary for the proper functioning of the back office operations. In case there are any lapses in the back office operations, compliance would get adversely affected, which will result in penalties, and such penalties cannot be passed on to the clients as the client was at no fault. Now, in such a situation where the financial ledger balance is showing nil, though the client has already paid and the money is showing as a credit in the account where it is closed, to comply with the margin compliance, one has to pass a JV between these two accounts. The account which has been closed has to be debited and the account which is active needs to be credited on the day it has been identified. Please note that you should not pass a JV on a back date, as because you have already given the information to the exchanges regarding the client bank balances. Once the money is credited to this particular account, you can show compliance, but unfortunately the upfront margin will show as deficit, and the penalties which will come will have to be borne by the trading member, as because it was not diligent.
Sudipto sir, I have heard all till now all the coordinations we need to make and all necessary actions need to be taken to mitigate these circumstances or these problems. But are there any circulars or any legal citations where you can describe us and we can understand how to mitigate these problems? I have another question. How we as a broker can be subjected to monetary penalties from exchange or SEBI, and how we can take actions so that we don't have to bear these penalties, and how can we, as per the circulars and guidelines or any legal citations are there, where from we understand how to function so that we can be more safe regarding these penalties and we don't get penalized.
Amit, you have asked a very pertinent question. However, there are no direct circulars or I may say any citations which have to substantiate such lapses which have been narrated by Bajrang ji. However, I will share certain circulars as well as citations where stockbrokers who could not update the back office for the credits which was received by it have been pulled up in arbitration platform and have to cough off money which was penalized on the stockbroker and could not have been passed on to the clients. So let me share those. You will understand that how important it is to update back office, and I will also provide you the solution that in case you are not being able to identify the credit, how to insulate yourself from any type of regulatory or client complaints. Now let me take you through the arbitration orders as well as the relevant circulars which are referred in the arbitration orders. Before I share the arbitration orders, I want to make some declaration that these arbitration orders are available in the public domain, and the references of these arbitration orders are not meant to defame the concerned stockbroker or any persons. This is an arbitration order between Ventura Securities and one Mr. Kilaru Charan Suresh. The complaint was registered by the client before the NSE forum. The NSE forum had referred this matter to the grievance redressal cell, and a GRC member was appointed to adjudicate the matter. Now, what was the matter? The matter was that the client had transferred some money to the trading member client bank account from a account which was not registered by the client in the records of the trading member, but the particular bank account was held in his name. He had transferred some money on a margin call on the very same day and shared the details to the branch manager of the trading member. However, the trading member did not recognize the transfer on the pretext that it was not from the registered bank account and showed that there was short margin. Later, the open position of the client was liquidated and the client had to suffer losses in respect of the price fluctuations as well as the margin shortfall. Based on the submissions of the complaints of the client and the response from the respondent trading member, the GRC member adjudicated in favor of the client, and the claim, which was around 40,000 rupees, was settled around a little more than 20,000 rupees. The trading member, Ventura, was aggrieved by the order passed by the GRC member and approached the arbitration mechanism of the stock exchange and filed an arbitration application. The learned sole arbitrator sought response from the client in respect of the arbitration application filed by the trading member. The trading member was also asked to file the rejoinder. Thereafter, hearing took place, and upon adjudication, the sole arbitrator found that the order passed by the GRC member was not adequate, and it had set aside the order and directed the trading member to pay a higher amount of around 41,000 in comparison to 20,000 odd rupees which was ordered by the GRC member. The trading member was aggrieved by the order passed by the sole arbitrator and approached the appellate arbitration tribunal framed by the stock exchange. The appellate tribunal heard the matter and tried to find out the illegality on the award passed by the sole arbitrator. Appellate arbitral tribunal upon going through the award passed by the sole arbitrator and the question of law regarding updation of financial ledger, found that the trading member had faulted in two SEBI circulars, namely the circular dated 27/8/2003 and the SEBI circular dated 1st June 2018. The captioned circulars pertain to the acceptance of funds by the stockbroker from their clients. The Appellate Arbitral Tribunal found that these two circulars were grossly violated by the trading member, and based on their findings, they had confirmed the award passed by the sole arbitrator and pulled the appellant trading member that it was wrong on their part to liquidate the positions which were held by the respondent, as the funds were already provided by the client to the trading member in time. So, if you go through these two arbitration awards, you will see that both the forums was very clear about two things. One, that a stockbroker has to update the records promptly on the very day the funds are being credited to its bank account. Now, where did the stockbroker fail, or any stockbroker could have failed? The stockbroker again failed due to the lack of communication between the sales department and the back office department. In this arbitration matter, the client had promptly informed the branch manager of the trading member. The branch manager must have updated the back office persons who are dealing in updation of the bank records, but they did not do the updation because the KYC department had to first register that bank account. So promptly they should have immediately coordinated between the sales officer and the KYC department to update the KYC records of the secondary bank account. So this lack of communication has led to this problem, and unnecessarily the trading member had to face these financial losses, initially by 20,800 rupees and later on by a higher amount. Not only this, while appealing before the appellate tribunal, the trading member must have paid almost a lakh of rupees as arbitration fees. So just for a simple lack of coordination, one had to face not only financial losses but also legal implications which are now in the legal domain. We have to learn from these latches which are found by the operations department, and unnecessarily a trading member has to face the brunt of the compliance wand.
Sir, you have referred some SEBI circulars related to this matter. So, I request you to please explain these circulars for our better understanding.
Regarding the circulars, Tamari, the first circular had come sometime in the year 2003. I will take you through the circulars. The circulars are relating to the mode of payments which a stockbroker can accept from clients. So let me show you the provisions. Basically, these provisions are sacrosanct, and that is the reason the learned arbitrators have harped upon them to show the stockbroker that if you receive a fund, it has to be accounted. So let me take you through the circulars. The first circular referred is of 27th of August 2003. The circular is captioned Mode of Payment and Delivery. This circular emerges from a letter which SEBI had given sometime on 18th of November 1993 regarding regulation of transaction between clients and stockbrokers. This circular reiterates that stockbrokers and subbrokers should not accept cash from client whether against obligations or as margin for purchase of securities and oblique or give cash against the sale of securities to the clients. The circular enshrines that all payments shall be received or made by the brokers from or to the clients strictly by account pay cross checks or demand drafts or by way of direct credit into the bank account through EFT, which means electronic fund transfer, or any other mode allowed by RBI. The brokers shall accept checks drawn only by the clients and also issue checks in favor of the clients only for their transactions. However, in exceptional circumstances, the sub-broker or sub-broker may receive the amount in cash to the extent not in violation of the income tax requirements as may be enforced from time to time. Now this bit, that is in exceptional circumstances, the broker or sub-broker may receive the amount in cash, has been dropped by another SEBI circular which was been enshrined in the year 2018. I will take you through that circular as well. On 12 July 2018, SEBI brought about a circular regarding discontinuation of acceptation of cash by stockbrokers. This circular of 12 July 2018 referred to the SEBI circular of 27th August 2003, and it said that all payments shall be received made by stockbrokers from or to the client strictly by account pay cross checks, demand drafts, or by way of direct credit into the bank account through electronic fund transfer or any other mode permitted by the Reserve Bank of India. The stockbroker shall accept checks drawn only by the clients and also issue checks in favor of clients only for their transactions, not for third-party transactions. Stockbrokers shall not accept cash from the clients either directly or by way of cash deposit to the bank account of the stockbroker. So, the 12th July 2018 circular clearly excludes or debars the stockbrokers from not accepting any cash from their clients either directly or by way of cash deposit to the bank account of the stockbroker. So, the basic crux of the arbitration order and harping upon the SEBI circular is that if a credit is being made to the client account, the client bank account of the stockbroker by a client, the stockbroker have to make all efforts to assign to a client. Now, the question may come that in spite of giving the best of the efforts, the stockbroker could not identify the client that who has given this money. This could be a pertinent question. To resolve this challenge that who has given this money to the client upstreaming bank account, if it remains unresolved, has to be tackled in a manner so that the stockbroker is never pulled up regarding its intention to comply. So the basic theme is, first, that there should be an effective communication methodology amongst all the departments for assigning any particular credit in the client upstreaming bank account and the intention to comply with the guidelines. So now I will try to explain that what methodology can be taken up by a stockbroker to ensure that this credits which has come from unknown accounts and the stockbroker could not identify the source client, how it can be complied. There are two ways which can be done. First, any credit which is from an unidentified account has to be reported to the bank. A communication, preferably either on the day the funds have been received or at least on the next early working day, has to be intimated to the bank, and it should be kept on record that the stockbroker had tried to make efforts to identify that particular bank account which was not identified from the database of the stockbroker. The second methodology is that a general mailer to all those clients who are having debits, or possibly if it is on a round figure, it should be circulated amongst a general mailer, through a general mailer to all the clients, at least to give a chance to the client that the credit has not been identified. If these two aspects are covered by the compliance or the operations department, I am sure that the regulators or the exchange would at least understand that the stockbroker had all the intentions to comply, but due to lack of information, it could not assign that particular transaction to a client. I am sure that if somebody has the intention to comply and the intention to have an effective communication, all these issues which lead a stockbroker for unnecessarily compliance hassles or legal hassles or monetary hassles can be resolved in a seamless manner.
So friends, we have heard the explanation from Sudipto sir, Bajrang ji and Amit ji on the importance of the updation of the client's funds to the upstreaming client bank accounts and also in the financial ledger. We have also heard the solution provided, and please you can comment us and share your feedback in the comment box. We'll come up with another interesting topic very shortly. Thank you everyone.